This is part one of a two-part presentation. Focus on consolidated financials when a parent buys 100% of another company. And we'll look at what happens, the journal entries, if they are dissolved, the subsidiary, or if the subsidiary remains a separate corporation. So we're going to look at the how do you come up with the account balances and what are the entries on the working paper so that you get consolidated financials. FASB ASC Topics 805 and 810. These provide the guidance using the acquisition method. Now, before the acquisition method was, when they came up with that ruling, it used to be that we used what we called the purchase method. And under the purchase method, if you only owned 60% of another company, you only showed 60% of their equipment, 60% of their liabilities. That's all you showed on the consolidated financials. But under the acquisition method, we treat them as if they're one, and if you own more than 50%, you have to show 100% of the subsidiaries' assets and liabilities. The acquisition method, again, embraces the fair value measurement for measuring and assessing business entity. Now, what is it to be consolidated? If dissolution occurs, all appropriate account balances are physically consolidated in the financial records of the survivor at fair market value. If separate a corporation is maintained, only the financial statement information via work papers is consolidated. Required. Ownership has to exceed 50%. Except when control does not rest with majority investor. One set of financial statements prepared to consolidate all accounts of the parent company and all its controlled subsidiaries. So what does that look like? Well, the parent buys the stock of the subsidiary. The parent, once they own more than 50%, have to prepare consolidated financial statements. The sub still prepares their own separate financials if they're kept as a separate entity. The acquisition method. The acquisition method is required to account for a business combination. It embraces the fair value in measuring the acquirer's interest in the acquired business. Applying the acquisition method involves using fair value to recognize and measure the consideration transferred for the acquisition of the business and a non-controlling interest if you don't buy 100%. The parent doesn't buy 100%. Separately identified assets acquired and liabilities assumed, and showing goodwill or gain from bargain purchase. Intangible assets are they lack physical substance, excluding financial instruments, arise from contractual or other legal rights, can be sold or otherwise separated from the acquired enterprise. Pre-existing goodwill recorded in the acquired company's books is ignored in the allocation of the purchase price. R&D that has reached technological feasibility is capitalized as an intangible asset at fair value with an indefinite life that is reviewed for impairment. Ongoing R&D is expensed as incurred. Related costs. Direct costs of the acquisition are not part of the fair value received and are immediately expensed. This is anything you spend outside the company. Indirect or internal costs are period costs. Costs to register and issue securities are treated as a debit to additional paid-in capital. Contingent obligations are considered part of the consideration. A contingent obligation is when a parent buys the stock of another company and they want the officers to stay on, so they have them sign a contract that says, if you stay on for so long, we're going to give you so much money. That's called a contingent obligation. Okay, so now let's take a look at an example. On January 1st, BIG issues 15,000 shares of its $4 par common stock with a fair value of $50 per share. Big also paid $25,000 for stock issuing costs in connection with the merger. First thing we want to look at is there any goodwill? Well, first of all, what we need to do is look at consideration, which is going to be the 15,000 shares at $50 or the fair value per share. Then we're going to less the net book value, which is going to be the assets minus the liabilities. The excess over book now must be allocated to under or overvalued assets. Now the accounts receivable is overvalued, so we're going to have to reduce that or add back in 2,000. The trademark is undervalued by 130,000. The record music catalog is undervalued by 120. The in-process R&D has a value of 200,000, and the notes payable needs to be reduced by 5,000, which is you add that back in. So when we add all those up, of the 480,000, we're going to assign 450,000 to the under overvalued assets, and we end up with goodwill of 27,000. So now we've solved for goodwill. Now the next thing we're going to look at, same problem, is we look at the balance sheet for big and little, and what we're going to do next is figure out, first of all, what are the effects on Big's balance sheet by issuing the stock and paying those stock issuance fees, and then what are the journal entries if little is dissolved or not dissolved. So the first thing we need to take, first we'll look at, well, what are the journal entries if little is not dissolved? Well, we're going to set up our investment in little account for $750,000. We're going to add an additional common stock of $60,000, and we're going to add to that total of for additional paid-in capital of $690. We're also going to reduce additional paid-in capital by $25 and reduce the cash of the parent by $25. So now we can determine what are going to be the balances at the time of the purchase so that we can do working papers to figure out consolidated financials. Balance after stock issuance on Big's books. Common stock, Big. We would take their balance plus the issuance of the stocks at par. So now we know their balance should be 460 on their balance sheet. Additional paid-in capital, they were at 30. We have the difference when we issued the stock because it had fair market value of 50 minus the par 4. But remember, we also have to less the stock issuing fees, which are a reduction in additional paid-in capital, and that gives us $695. And then the cash. They had 60. They issued stock of 25, so now cash has a value of 35,000. Now, these are the totals we use when preparing the working papers for consolidated financials or trying to figure out the ending balances. So you can do this just if part of your homework is figuring out the ending balances, please make sure you take into consideration the effects of issuing the stock by the parent. All right, this is what we would call working papers because we don't make these entries on the books of the parent. Instead, we set up working papers and we show Big's book value after the issuing of. Now let's go through the entries that you would use on the working papers. And you would do them in this order. It's pretty simple because it's a very simple one because it's at the time of the purchase. First, we're going to eliminate the equity accounts for the sub. That's what we call entry S. So what we would do is those have a credit balance, so we would debit those. The next thing that we would do is adjust all little's assets and liabilities to fair value. So that's booking all of the adjustments that we discussed. And then the last thing we do is zero out the investment account. And now we have in this column right here, these are all of your consolidated balances, which would appear on the parent's balance sheet. Now, what if little is dissolved? Well, what we would do first is we would book all of the assets at fair market value and record the goodwill. We would then book the liabilities at fair market value. And we would book the common stock. And then we would book our additional paid-in capital for the stock issuance costs. And that ends this presentation.